The Congressional Budget Office, known in your hood as the CBO, estimated that the GOP's tax bill will increase the deficit by $2.4 trillion over the next 10 years. University of Pennsylvania's Wharton budget model estimates that it could increase by as much as $4.3 trillion, with the Senate and House hoping to have a finished version of the tax bill ready by July 4th. This could be the next big piece of economic data. I want to bring in Brett Ryan, Deutsche Bank's senior U.S. economist. And still with me, we've got Thomas Hayes, Great Hill Capital chairman and managing member. Great to have both of you here on set for this conversation. Brett, as we consider what Ben was just breaking down and teeing up, and what we're seeing in the difference of long-term costs that are anticipated here, how are you and your team kind of running the modeling around this?
Yeah, sure. So you have the near-term impacts, which, all of the tax benefits, especially for businesses and some of the individual measures are front-loaded, but the cost savings are back-loaded. And, we've seen this before. And the question is, are you ever going to realize those cost savings? There's obviously substantial debate over Medicaid, and that's where a good chunk of the cost savings are coming from. So there is a very real question around that. I think near term, it's probably about 100 to 150 billion of additional stimulus to the economy on top of the extension of the TCJA. So, you keep things baseline, and then you're adding about another 100 to 150 billion over the next, let's call it 2 to 3 years.
And so, Tom, there might be people out there wondering, why is this the next major catalyst for the markets, knowing that we've already moved through the Fed's most recent decision and they gave some type of, or at least alluded to how they're thinking through certain aspects when asked about it. And then additionally, we already had stronger Treasury auctions that took place the week prior to that as well. So what is the larger implications that traders and investors are thinking through in their mindset?
The most important thing here is the tax cuts. Okay, so we've gone from bombing and tariffs to growth and deregulation. And growth is a function of the tax cuts. As Brett is alluding to, it's a little bit stimulative here, and you can kind of talk a little bit more about that in detail. I would just say, so that's critical. So, if tax rates were to go up, it's going to impact earnings. It's going to have a negative impact on the economy, hiring, growth, the whole thing. So that's not going to happen. We've got the Treasury doing what they're doing with the SLR. We've got the tax cuts coming in, and animal spirits coming back because management can plan. They can start to forecast, kind of understand the rules, whereas the first half of the year, everyone was uncertain. So, Brett, how do you handicap this getting done by July 4th, or no vacation, no one goes home, locking them in a room? You've been through this process many times. Does this look any different, or is this just the normal back and forth and eventually they get something done?
Yeah, it does look like the normal process of back and forth. It's just that they are the two biggest portions of this bill, which are SALT cap and Medicaid, are still outstanding, and we're a week away. And so, our baseline has been that it gets done sometime after the July 4th recess. This is an arbitrary deadline. Yeah. There's the only thing that the shot clock here is the debt limit, and that's not until September or October. So could this slip till later? Of course, absolutely. But to your point about markets, this is a large anticipation. As we saw in the wake of the 2017 tax cuts, the share buybacks increased materially. That's one of the reasons why equity markets are probably a little bit bouncing back from all of these issues.
Yeah. What we've continued to hear from President Trump and some of his cabinet members is that the tariffs would pay for the tax cuts. What would the long-run effective tariff rate need to be, even as we're getting some of the kind of leaked announcements, or at least Truth Social posts that are saying, hey, we're going to be collecting more in tariffs from certain countries than we already are? What would that long-run effective rate need to be in order for a true offset and mitigation of some of the larger sums that we've seen projected by congressional budget offices and some of the economists out there be? Sure.
It's not as easy as saying, X rate is going to translate into paying for it. At about a 15% rate going forward, you could theoretically pay for, 3 trillion of this, but at the cost of about 7 trillion of imports.
Wow.
And at the cost of growth at the same time. And so, there's what's eventually going to happen if you keep these tax rates in place permanently is you're going to have substitution effects. Some will be domestic produced. There's also be demand destruction. So, it's not as simple as saying, okay, these tariffs are not being legislated. Mm-hmm. They could be removed at any time. other countries are also not going to take them too kindly. The EU has already threatened retaliation if the 10% baseline tariff remains in place. So we have a bit of an issue in this, and one of the key measures of the tax bill, Section 899, is causing some consternation in markets as well, especially for multinational firms. And so, you have elements of the tax bill that are meant to be leverage and sort of a threat to really correct other countries' tax issues that will be addressed in trade discussions. Kevin Hassett says, okay, well, we're going to do these trade deals after the tax bill, but then Section 899 doesn't need to be included in the tax bill if we do the trade deals. Okay, which is coming first here, Kevin?
Right. Just as a follow-up to that, because we've often heard some of the officials and cabinet members talk about this being an administration that is focused on Main Street. But what you were just laying out seems like it benefits more of the businesses that, as exemplified, can be more quick with some of their import, are much more large and able to kind of shift around quickly because they have more dollars, more weight to throw around as well. So what does that mean for small businesses and how they're able to wade through a longer or a prolonged period that tariffs are going to impact them?
Right. I mean, that's a bit of the tension here, is that the tax bill does have a lot of good small business provisions in there. There's no question about that.
Bonus depreciation stays in?
Love bonus depreciation. Yeah. That's exactly. These are all good things. The problem is the small businesses are the ones that are least able to deal with the tariffs. Yeah. So you have this tension in terms of what you're trying to accomplish here and the goals that you're trying to meet. Not all of these policies are rowing in the same direction. And that's kind of one of the issues here, which is going to ultimately outweigh things. Now, the tax bill, as Thomas mentioned, is going to provide at least some certainty here. Every 90-day delay is another 90 days that companies are, well, I'm waiting to see what shakes out. Mm-hmm. And so the sooner we can get done with that, the better.
We have 30 seconds left here, and we were discussing earlier what the signaling of who the next Fed chair could be might look like in terms of commentary that we could hear from that person in a almost shadow Fed, because that person wouldn't be going in until May 2026, but we'd get more inclination through what they're willing to talk about openly and publicly, and policy could be one of those areas where the Fed typically will not comment on that and try to be apolitical. Yet you would have someone who would be put forward in their name and have pretty much open season to say whatever they want leading up to that point.
I think it's less what they say and more who they are. Yeah. So, if Hassett's the guy, I think the market starts to discount that pretty darn quick, and that's going to have long-term implications in terms of refinancing the debt, the cost of the debt, et cetera. But I have one last question for you, Brett. What do you think, as the bill stands right now, what do you think that adds or detracts from GDP in the short term over the next 12 months? If it went through today as is, incremental benefit or drag?
Yeah, it would be about 40 basis points positive.
Wow.
Depending on where you put some of the scoring. But yeah, from a deficit, from a fiscal impulse perspective, 30 to 40 basis points positive, for sure, that's relative to trend. And so, that's if the Fed's trend is 1.8. You're looking at 2.1. Our forecast is around 2% next year. But again, a lot remains to be seen. Fed chair, that's a whole different. That's
another hour.
I think the next Fed chair, you have to be careful, as you alluded to. If the market loses confidence that the Fed is independent, then your long end is going to be a serious problem, and it doesn't matter how much you cut in the front end.
The GOP is using a controversial budget maneuver that is hiding $3.8 trillion in President Trump's tax bill. For more, we'll bring in Yahoo Finance Washington correspondent Ben Werschkul. Ben.
Hey, Josh. Yeah, so while negotiations grind on Trump's big, beautiful bill, what I wrote about today was this concept called the current policy baseline. I know this is kind of a wonky inside baseball concept here in Washington, but this is massively shaping how the bill is being discussed this week. Economists hate it. To set the baseline. They call it an egregious budget gimmick. And it's why you see the same bill coming out and being scored two different ways. In one example this week, the tax portions of the Senate bill, you could either say it costs $442 billion or $4.2 trillion. And this is because the Senate argument is that any tax rate currently in policy and that's being extended should count as zero because it's not changing. And that, of course, is about the individual tax rates in the 2017 Tax Cuts and Jobs Act, which expire at the end of this year, and is the sort of main point of the tax bill to extend it this year, making that cost zero. And this all comes as we're kind of entering this final stage of negotiations on the bill with the final shape of it far resolved, and a lot of changes we've seen just in the last few hours, suggesting that the price tag here could go higher and make things even harder for the fiscal hawks who have to vote yes for this to pass. We've had John Thune has acknowledged that a vote starting tomorrow may not be possible, but the Senate is still trying to get this going for the weekend. One comment I heard just a few minutes ago was that the goal here is for final votes by the time work begins on Monday. So we'll see how that goes.
And Ben, what is the latest, by the way, on Trump's tariff revenue? He likes that revenue, Ben. So what's been coming in?
Yeah, so we get an updates on this nearly every day from the Treasury Department. They have a daily statement, and that gives you customs and certain excise taxes from the Department of Homeland Security. And they come that in, and there's usually a big deposit about this time of the month. And we had the one from for June. And what it shows is that we are on pace for another record month of tariff revenue. It's 26.7 billion has come in so far under this metric, and 121 billion has flowed in through the entire fiscal year so far. And that's another jump from last month, and kind of comes as Trump's tariffs continue in place, and they promise that they're going to keep going on. And this comes also after the Congressional Budget Office has talked about how tariffs could add somewhere in the neighborhood of 2.8 trillion over the entirety of the next decade if they stay in place, and if Trump, even after Trump is scheduled to leave. The reality check here is this is still a long ways off, even with this really significant jump, from being a huge piece of government revenues. The government takes in north of $300 billion every month, sometimes much higher than that during tax season. So this is still about 5% of government revenue, which is a big jump from 2% that it was in recent years, but it's still a long ways from the big ones like income taxes.
All right, Ben. Thank you. Appreciate it.